It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR bonds. Download the INR bonds app to save better.
Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsati. And in this edition of Search for Yields, I'm going to talk about how bonds are actually giving certainty of returns to investors in a highly uncertain environment for investors. Now, in this year, been extremely volatile. We have seen equity markets falling very sharply, and especially across all classes, at the small, mid caps, everything. So investors have been very, very badly hurt in equities because the markets have done very well in the last couple of years. The In the other assets, even the gold actually not has done too well. So gold has not been a great hedge against inflation, and the rupee, as we all know, is trading at record lows. So nothing is helping on that as well. And the other assets, which is bonds, are actually have lost money for investors. And that's because interest rates have gone up. So now why am I saying that um, bonds are giving certainty of returns to investors, right? Okay, so when I mean bonds, I mean the right bonds and very select bonds to generate certainty of returns and keep the returns that is visible in a very highly uncertain environment. Just before that, download our app, QuickInvest by INR Bonds, where these bonds that most of the bonds that investors have invested through QuickInvest have actually given full certainty of returns. And even in this highly rising and negative return market, even in bonds for many investors, they have actually seen very good returns with good certainty. So download our app now. It's available in iOS and Android, and you can go to the link in the description below for the downloads. Now coming back to the search for yields. When I mean certainty of returns, that means that if you invest X amount of money, you should expect an X% of returns, and this return should be certain. Now, while uh, if, and this in a very uncertain investment environment, where supposing you invest in any assets, you're not very sure what returns you're going to get. So what bonds can give you this certainty of returns? Clearly, the certainty does not arise in bonds that are of higher maturity. That is anything from 2 years, 1 year plus and above. And because if interest rates rise further, then all the prices will fall, right? So clearly, any bonds, even if they are looking, for example, the 10-year government bond, that is very high maturity, that has gone up by 150 basis points in the last 1 year, from 6% to 7.5%. So the negative return the investor earned is about minus 10%, which is very high for a bond, right? So this is not certainty. This is uncertainty and actually negative returns. Now, even if investor invested in 2 to 3 year government bonds or corporate bonds, they have actually lost money because yields have gone up very sharply, again by 200%. So the negative returns are maybe zero, maybe minus 1% or minus 2%, depending on what bond they have invested in, right? So this again uncertainty, and even at these levels, even if with rise in yields, 2 year bonds and even 2 3 year bonds or 10-year bonds, for this year the returns are looking highly uncertain because no one knows where inflation is going, where RBI will hike rates, what's happening to global inflation, because we are seeing the Fed and the ECB panicking, and many governments globally are putting pressure to bring down inflation because it's hurting their popular citizens. So coming back to our Indian investors, now clearly where they have lost a lot of money or seen very, very low returns in most of the investments this year. What are the bonds that are giving them certainty of returns, good cash flows, and also and what bonds can they look at to invest in, give them certainty of returns, even if interest rates rise. So the way to look at this is to how insensitive a few bonds are against interest rate increases. And what you need to do is see the absolute level of yields of bonds and the spreads. So if the level of yields, say, are for a 1 year bond, say 8.5 or 9% or 10%. So even if uh, over the last 1 year, supposing somebody had invested in a bond, 1 year bond yielding 8%, then if even if interest rates have risen by 100 or 1%, by the time the interest rates have risen by 1%, the bond is still at about 2 to 3 months of maturity, and it's still a very attractive yield. In fact, many investors can actually sell it at lower levels of yields and make capital gains as well. Similarly, if you invest in bonds that are, say, again, interest rate insensitive at anywhere in a 1 year bond or a 2 year bond, which is yielding anything over 8, 9, 10%. And then these bonds tend to be highly insensitive to interest rate rises. And they continue to be so. But the main factor one needs to look at is what is the credit risk they are taking. Obviously, such bonds come with credit risk. So if investors can identify good bonds with good credit risk and certainty of returns, even if interest rates rises, then they are actually locked onto the yields. They're able to beat inflation and are smiling away with their portfolios looking much better than all the other portfolios that have been seeing a huge amount of volatility in their returns. So it is a time where investors should continue to search for the correct bonds to invest in, wherein bonds can mature early with interest rate certainty, where they are insensitive to rising interest rates in government bonds, as well as RBI repo rate hikes and lack of liquidity in the market. That's about it for Search for Yields. Thank you for listening in. And do not forget to subscribe to our YouTube channel if you've not done so already.